Hey, what's up, people? I want to talk about a little bit of what's been happening in the market, right? So, the last few days, week or so, market's been down heavy, right? And I want to talk about what the difference it's making in me doing cash flow type investing than investing for long-term growth, right? So either way, there's no right or wrong to what you want to do with the investing, right? As long as you're making money, as long as you're progressing to what your goal is, then that's really what matters. Now, a lot of people like to compare what one person is doing, what another person is doing. I try to teach people when I coach them and when I talk to them about investing courses and classes and stuff like that. I said, listen, don't compare your goal to someone else's. You have different needs and different things you want out of your portfolio than other people. So don't compare what you're doing to someone else. You go after the goal or strategy that matches what your needs are. So anyways, mine's for cash flow. With cash flow, the market has been a bloodbath. It has been down. It has been red. It has looked ugly. Nobody wants to be there, right? I am feeling confident in what I'm doing strategy-wise because even though it's down, I'm going to keep getting paid cash flow because I invest in different funds and I've set it up so that most of them pay monthly, some of them pay weekly. So, and some of them they pay on different weeks of the month, first, second, third, or fourth week of the month. So either way, if I didn't have some of the ones that pay weekly, I'm still getting paid weekly because there's something coming in every week from some fund. Now there are a couple weeks that are big weeks or little weeks in comparison because I have the majority of them in a certain week than another. But the point of it is, right now while the market's down, I am still going to receive cash flow. It might be less cash flow than it was, but as I said in the previous video, the goal is to get so much cash flow that even if you get paid a little bit less because of market correction or market downturn, you don't care. That is the goal, okay? Quick example of it, there's people I follow that are on YouTube and other places that their portfolio is bringing them in $30,000 to $50,000 a month. All right, so on a regular nice month when things are going great, it's bringing in 50 grand plus per month. On a month where things are going bad, it might bring in 40,000 or so. So when you look at that amount of volume in dollars, $10,000 a month is a big difference. But if you're going from 50 to 40, I think you still have more than enough to live a comfortable lifestyle, be able to be a blessing to other people, be able to take care of your family, and be able to free up your time because a lot of things that you need done, you can get done because you have resources to make it happen. So that's the goal, right? The big picture. But also I want to talk about margin. A lot of people mentioned to me about how, for my example, I decided to leverage margin that I can get through my brokerage account to increase the cash flow, right? Because if I can borrow money at a low rate and use that to invest to get more cash flow by having more shares, then I increase the amount of money that I have coming in dramatically more than what it cost me to borrow that money. So in my example, people talk about margin calls and how, oh, when the market corrects and goes down, you're going to get a margin call. Well, just to explain it real quick, whenever you start using margin in your brokerage account, you'll have what's called a maintenance minimum. Now, I use Robinhood. That is the brokerage account I found that has the lowest cost for margin. They literally are being like so easy about giving away additional money. Like their rates are super low. If you Google the rate charts for margin, if you Google other brokerages and see what their margin rates are, you'll see that Robinhood's way less. Anyways, you have a margin maintenance minimum. The maintenance minimum is the amount of money you have to keep in your portfolio in order to continue borrowing the margined amount, right? So for easy example and easy numbers, let's say you put 100 grand in, and you may not have put that all in at once. Over time, you incrementally kept putting in money, kept reinvesting, kept doing what you're doing, but you got up to 100K. You have that in your portfolio. If you margin all of that, most brokers are going to give you another 100K that you can do whatever the heck you want with. You can withdraw it, you can buy other funds, buy other stocks, buy other things, right? So let's say you used all of the margin to buy other funds. So now you effectively have $200,000 invested, not $100,000 invested, right? So let's say if on that $100,000 you were bringing in 2,500 a month or 3 grand or 5 grand, let's just say 5 grand a month, make easy math. If you now have $200,000 invested, you're now bringing in 10 grand a month. So if you look at the difference there, by doubling the amount you had invested, You literally doubled your cash flow from 5 to 10. Now, why does that matter? Because in real life, percentages make a difference in larger chunks of money, right? 10% of a dollar is a dime. 10% of 100 grand is 10K, right? So the difference in that is the 10% is still the same, but you can do a lot more with 10K than you can with 10 cents. So when you're able to use margin to increase your cash flow higher, you're creating more opportunity for yourself, because there's a certain limit of money where once you have it, you have more than enough to cover your bills and expenses. And if you don't get crazy with it and start increasing your lifestyle in ways that are not necessary, then you're going to have a lot of margin left over. You're going to have not a lot of margin. You're going to have a lot of money left over from using the margin. So anyways, let's say you did that. You have 200K invested. Your maintenance minimum is a percentage that your brokerage account calculates to let you know what the minimum amount of money is you have to keep in your account to be able to continue borrowing what you have. So let's say your maintenance minimum is, for easy math again, $50,000, right? So 50% of what you invested, you had 100K in, they let you borrow another 100, so you effectively have 200. But if that original 100 you put in, they do a math calculation to figure this out. It'll just show you on your dashboard. I'm not going to explain all that to you. Your dashboard will normally show you the amount of money that you have invested and its value, not the amount of money you have invested in your margin. So if you click through and look at your margin details, it'll show you, yes, you have $200,000 worth of funds and stocks that you're invested in. But when it shows you your actual portfolio value, it's going to show you the money that you have contributed to that total. So if your margin maintenance is 50%, you have to keep at least half of what you put in your account in that value, or you're going to have to pay back the margin or pay back a piece of the margin, right? So if your margin maintenance is 50%, let's just talk about the recent stock crash or recession that's happened, right? Or pullback, whatever you want to call it, the last few days. It went down like 25%. Okay. So if it went down 25%, that means your 100 that you put in is now worth 75, right? Because you bought all these funds or whatever, the funds all went down, the whole market went down. You had 100K invested in something, but now it's worth 75, right? So the other math of that is you'd have to do the math on what that would be for the 200. So the 200 is worth 25% less. I'm not doing the math on that because it's too much for my brain right now. Either way, on your dashboard, it's going to show your 100 is worth 75. So you're still not in a margin call. The market's down. If you were to sell everything, yes, you'd sell some stuff at a loss, which I wouldn't suggest. At least I'm not going to do. But you still don't have a margin call. If your margin maintenance is 50,000 out of the 100 that you put in, you haven't met that yet. You have to have a 50% market correction or downturn in order to meet your maintenance minimum with the amount of money you have invested. So then, let's say the market continued to crash and it went down 50%. So your 100 is now worth 50. And then it goes down even further to 49,000. Well, now you're $1,000 below your maintenance minimum. So your brokerage account is going to say, hey, you've got about 7 days and you've got two options. You can put $1,000 in your account to get your value back up to 50,000. So you're at your maintenance minimum for all the 100K we let you borrow. Or you can sell some of your stocks or shares of your funds in order to create $1,000 worth of money and leave that in your brokerage account. Don't withdraw it. Let that get you back to your maintenance minimum. Now, selling them at this point, if you lost 50% value, that means you'd have to sell double your shares to get your money back because you paid double the price for them and now they're worth half of that. So instead of doing that, you say, okay, well, in another week, I'm going to get more dividends and those dividends are going to be more than $1,000. So I don't have to do anything. I'm just going to let the $1,000 I get in dividends come in and that'll bring my account back to wholeness. Now, the difference I see here in cash flow investing and long-term investing is a long-term investor loses money because the market goes down 50%. They're just down 50%. If they didn't sell before the crash happened, then they're just down. They have to wait for it to come back. Who knows how long it takes? Sometimes it can take a month. It can take 2 months, 3 months, a quarter, half a year, whole year, 2 years, 3 years, 5 years. When you look at cash flow investing, the market is down, but I'm still going to receive payments. The funds I'm in are still going to pay me because it's written in their prospectus that their goal and what they do is to pay out of the funds, out of the money that they generate every month from doing options. So it doesn't matter if the market's down, because if you look at research of options, you can make money in options whether they're up or down. So it doesn't matter to me that the market is down. As a matter of fact, for me, it means when I do have dividends coming in, I'm going to get to buy more shares than I could before because they cost less. And also, people are saying that, oh, well, the distribution, the amount of money you're going to make is going to be lower because the market went down. But again, I say with options, you can do calls and you can do puts. Now, a lot of the funds I'm in do covered call option strategies. Some of them have some put strategies built in. You just have to read different ones to see how they operate. But the basic gist of it is the market went down and has opportunity to get back to the high it was at before, because I say um, today's highs are tomorrow's lows. So right now, we just hit a yesterday's low because the market's gone back down. That means there's opportunity for it to go back up. And historically, long term, when you look at the market, what does it do? It rises. I did a video about this before. You can look at the previous ones, but it rises. So what's great to me is during these down times, I'm still going to receive cash flow. And my goal when I leveraged debt and used margin in order to increase my cash flow was to get as much money out of the market back into my hands as quickly as possible to recoup what I've invested to that point. In this year, right now I'm projected for money that I put in around January, February, I will be projected to get all of that back by, let's say, October. The total dividends I would receive by October will be enough to already pay back what I put in a large lump sum earlier this year, leveraging some outside debt outside my brokerage. But just looking at the numbers and how fast the payback on that has been, it's really just opening my eyes to continue on this process for me, at least for my goals, because my goal is cash flow, because I want freedom of time to spend with family and do other things, help my community and do other things like that. But that's going to happen when I don't have to, when I'm not forced to have to go to work every day, or run a business every day, or do whatever. Because whether you work for someone or an entrepreneur, you're still working. You know, if you're not to the point where you're financially free and independent, then yeah, you're still working. So anyways, that's what tidbit I wanted to say. I'm not worried about the market going down. I'm just going to buy up more stuff while it costs less, and I'm still going to get paid this month. And as the market continues to rise in the future, I'm going to get paid more. And it's all set up now that I'm just going to continually keep getting paid. Oh, it's early. I guess I'm tired. All right, I'm going to go. That's it. We'll talk again. Hopefully that helps some people understand a little bit about margin, a little bit about why I'm doing cash flow investing, and if that's something that can work for them. And, you know, if you want some more info, details, write a comment, hit me up, send me a DM. We'll go from there. Bye.